What's up, apes? Hope everybody's doing phenomenally well out there. Happy Independence Day to all of my American apes out there. It is the 4th of July, the single best holiday in the entire world when we booted those fucking ugly-ass, disgusting teeth English people off of our land. I am so sorry to all my apes out in the UK. You guys are great too. It's just such an easy target to be able to make fun of, especially on a day like today when we're celebrating, more than 240 years of independence, coming up close on 250 years, although that 250 is going from 1776, but real historians know that the Revolutionary War began with the Battle of Bunker Hill in 1775 and didn't end until about September of 1783 with the Battle of Yorktown. So some good stuff, great reasons to be celebrating. But let's get ready for the markets on Friday here, because unfortunately, even though there is a day in between Independence Day and the weekend, we gotta get up, we gotta trade, we gotta make money. So let's get ready for that right now, because we got a lot to cover in today's edition. So first and foremost, the WSO Alpha portfolio, we had a relatively solid day here because of Tesla's relative outperformance. Once again, we were up 25 basis points. Now, we did underperform the rest of the market for the day. What can I say? It was a good day for big tech. We're not just going to follow the entire rest of the world into the big tech trade. That's not fun. It's not worth paying for access to a portfolio if that's what we're doing. But we are not here for short-term outperformance. We are here for the long term. Now, our three leading stocks of the day were Tesla, Enphase, and Zillow, three very recent purchases and ones that we published recent research reports on. So make sure to go ahead and subscribe to WSO Alpha if you want to be part of all of this alpha going forward. Now, up 25 basis points, like I said, relatively solid day. We're up 11.86% on the year, underperforming the NASDAQ and the S&P, but not for long. Let's go ahead and get into some of the banana bits for the session. So first and foremost, retail investors are going balls deep in the market right now. They are currently investing more in stocks and the least in cash than they have since November of 2021, which, for those of us who don't remember, that was the market high. That was the NASDAQ and the S&P 500's high in about mid-November of 2021. So retail investors are feeling about as bullish on stocks as they were back then. Now, we're obviously not at all-time highs exactly right now. We're, flirting with them just about every single day, but we certainly didn't close at an all-time high today. Nonetheless, retail investors are feeling themselves. Meanwhile, retailers, not retail investors, but actual retail companies, ones that make money, unlike retail investors, rival retailers, Saks Fifth Avenue and Neiman Marcus, are apparently combining. I don't know anything about this rivalry, but literally every financial media journal in the world was freaking out about this one. I'm not really too sure where the beef comes from, but apparently these two are rivals and they are now merging together. The parent of Saks Fifth Avenue is going to be purchasing Neiman Marcus. Meanwhile, Russia and China, it's time to get these guys a reality show. We need the Real Housewives of Moscow and Beijing. Somebody needs to drop that. Netflix, HBO, where are you guys at for that one? But it seems like this romance between Russia and China is getting a little bit rocky because basically China is going to all of Russia's exes, like the former Soviet states, and trying to slide into their DMs right now. And Russia is a little bit upset about it, feeling a little bit jealous. But China has been using the entire Ukraine war to kind of butter them up and, like I said, try to slide into those DMs. Anyway, the best stock trader to ever do it, the absolute GOAT, the best to ever load up a Bloomberg terminal, Speaker of the House Nancy Pelosi. She is trading once again. She's selling Tesla and Visa. She's buying Nvidia and Broadcom. Make sure to go ahead and check that stuff out. And finally, Greece. I've never seen a country hate its people more. So they started off by killing Socrates, by making him drink hemlock just for corrupting the youth, which was actually just teaching them about fucking reason, morals, and his overall philosophy. Greece is continuing that thread of fucking hating its citizens by forcing them into a 6-day work week. Yes, you heard that correct. I'm sure you've heard news over the past couple of years about the world moving to a 4-day work week. Greece said, fuck that. We fucking hate ourselves. We want to do 6 days, 48 hours per week, because the country's population is declining ever since they went bankrupt in 2009. The country really hasn't been able to recover. So instead of, creating incentives like we have in the United States to foster innovation and build large tech companies, they have instead decided, fuck it, let's just make everybody work more. So RIP to any apes out in Greece, where you have a spot here at the Daily Peel Global headquarters if you want it. All right, let's go ahead and move into the big story of the day. We are talking about the previews because it's labor market week here at the Daily Peel Global headquarters and in Wall Street more broadly. Yesterday, we got the ADP payroll report numbers, and the day prior, we got the JOLTS report. Let's go ahead and break down all that stuff right now. The important chart of the day is going to be right here. So This is showing us the total ADP payroll figures as well as additions on a monthly basis. So the total is this dark blue line. The additions on a monthly basis is this light blue line. And so obviously what we're seeing is declining additions month over month, but still growing, which is the important thing. And it shows 𝗟𝗂𝗪's absolute masterpiece of an economy that he has painted ever since raising interest rates without destroying the entirety of the job market. So in the month of June, ADP says that we added 150,000 jobs to private payrolls, a little bit less than was expected at 160,000, excuse me. 157,000 was the revised number for May, but this is what we're seeing in June according to ADP. Now we'll get the full employment report on Friday when you guys are done celebrating your hard-earned freedom, of course, once again for all the American apes out there. But for now, it was an overall decent report. Didn't really cause any comeuppance in markets whatsoever. The strongest sectors that we saw were leisure and hospitality, construction, and professional and business services. Notably, financial services added about 11,000 jobs, but not nearly as many as leisure and hospitality at 63,000, construction at 27, and professional and business services at 25,000. Now, those sectors that actually contribute to the economy that I just named, being, of course, leisure and hospitality and construction, definitely not professional and business services, seeing those continue to grow is a good sign for the economy because it suggests that people are traveling, people are leisuring, companies feel like they can invest in large projects, so they're going with construction spending. Bodes well for the long-term future of the United States economy. Now, on the other hand, natural resources mining, manufacturing, and information were the biggest losing sectors, losing 8,000, 5,000, and 3,000 jobs respectively. So, seeing the particularly concerning part about that is manufacturing losing 5,000 jobs. Manufacturing tends to be a leading indicator in the United States and for economies more broadly. So seeing that decline is definitely not a great sign, but it's more of a short-term cyclical basis, whereas the additions to jobs in things like construction and leisure and hospitality, well, especially construction, that tends to be a lot more structural than cyclical. So overall, still a good sign. Now, at the same time, with the JOLTS report, we saw a slight increase in the number of job openings. That might sound like a good thing. It's actually not, especially when you weigh it against the interest rate scenario. Usually that would be a good thing for people looking for jobs because it shows an increase in labor demand. Companies can afford to pay more people. But given the current interest rate and inflationary environment, that is definitely not what 𝗟𝗂𝗪 and the FOMC are looking for. Nonetheless, it really wasn't that big of a jump, and we can see that in this chart right here. So what we're showing, I think this might be the most important chart in all of finance right now. So in this blue line that you see, that is the unemployment rate. And in this red line right here, that is the total number of job additions per month via the JOLTS report. What we're seeing is that they are starting to not necessarily coalesce because one is a percentage and one is an actual number of people or number of job openings more specifically. But the reason that this is so impressive is because Jerome Powell and the FOMC, responding to the coronavirus pandemic, have effectively created a situation where they've been able to destroy labor demand without destroying unemployment, without basically ripping people from their jobs. Instead, with surgical precision, what they've been able to do is effectively kill labor demand for all of these openings that weren't previously filled. So at one point back in 2021, there was basically 2 job openings for every unemployed person in the United States. Now it's currently at 1.22 job openings per unemployed person in the United States, the exact same level that it was at in February of 2020. We can see this, not necessarily the number of job openings because it would be increasing as a ratio, so it's effectively the same right now. But the fact that we've been able to kill labor demand without spiking unemployment back above 4%, very impressive stuff. Now, obviously, it wasn't necessarily Jerome Powell who did that. It was a simple fact that when COVID came, this was a supply-side recession. So a supply-side recession is easier for a central bank to be able to handle. Now, provided that supply chains aren't completely fucked forever, it's easier in that case only. Whereas if it's a demand-side recession, that's where you get things like the Great Depression, which are much harder to dig people out of, convincing them to spend once again. But effectively, what COVID did was put all of our demand on hold, but it didn't necessarily stop the supply. Well, it effectively it put demand on hold by stopping the supply because, nobody could travel, nobody could really do anything that they wanted to do. When you're doing something like that, consumers remain on relatively decent footing, but obviously the supply side isn't there. So when the supply returns, consumers are ready to meet that supply, and it makes the Fed's job a lot more easier in that situation. So what this means is that for the first time in American history, the Federal Reserve and the economy more broadly has been able to kill inflation that was above 5% without triggering a recession. Now, that might change. Going forward, we're still at 2.6% annualized inflation right now. So If we don't get down to 2% without causing a recession, then 𝗟𝗑𝗏 is going to lose that title, but he does hold it right now. Once again, we included this labor market spider from the Atlanta Fed in the piece right here, going a little bit more in-depthly into it today. Some of the more important things that you can see. This once again just speaks to how well the economy has worked out since COVID basically showed up. What we can see here is the biggest declines are private hiring rates, but the biggest increases are average hourly earnings and employment cost index growth. So in this black line that we see for February 2020, employment cost and average hourly earnings are way down here, meaning they're lower, and then they expand all throughout time. Now they have slipped back a little bit from April 2024 compared to April 2023. That tracks well with declining inflation. So this just adds to the argument to cut rates sooner, lower for sooner. Once again, we'll see if the Fed actually does it. 𝗟𝗑𝗏 is probably going to wait a couple more months. Nobody expects anything until the September meeting. That's going to be the next actually important Federal Reserve meeting. If they don't cut at that, bet your life savings that they're going to at November and December. Personally, I'm starting to lean more towards the 2 cuts this year than the 0 cuts. That could blow up in my face. I could be very wrong. But let's go ahead and move on to some of our big stock movers of the day. First of all, we have Paramount Global. So we have a couple of billionaires getting together here. The son of Larry Ellison, the founder of Oracle, Mr. David Ellison, and Paramount, the daughter of Paramount founder Sumner Redstone, who was worth about $4 or $5 billion at his passing in 2020. Looks like they're actually going to make things work out. So David Ellison, he runs Skydance Media. We talked about this merger a little bit back in the day, but it didn't go through because effectively Redstone was the only one getting a premium. Common shareholders were, getting a very slight premium, but it certainly didn't feel like it was worth their while. Nonetheless, it definitely seemed like it was today with the stock being up quite a bit. Now, the likes of Apollo, Warner Brothers, they've all thrown in offers out there as well, but it seems like Redstone is going to pair up with her fellow heir to a billionaire and go ahead and work with them. So ultimately, at the end of the day, we saw Paramount stock was up by just about 6.9%. Now, I couldn't have painted a more perfect scenario than it being up 6.9%, but that is exactly what we saw. Moving on to our next big stock mover of the day. This is the 3rd time in a row that we were talking about Tesla. Tesla was up another 6.5% for the session. Once again, really just riding the wave of delivery numbers. So, not really much to talk about there. They did come in very solid with delivery numbers. Plus, Cathie Wood sold shares, actually. So to any sane, non-schizophrenic portfolio manager, that is a reason to buy, seeing Cathie Wood bow out of there. If you're looking for more detail on Tesla's deliveries, go ahead and check out our piece, as well as our podcast from yesterday. It's probably at about the, like the 12-minute mark or so. Probably about the same time, maybe more like 11 to 12 minutes. Anyway, in terms of losers, we didn't see a lot of big headlining losers for the session. Now, Amazon was down 1.21% for the day. Wasn't really a whole lot going on. Bezos is selling $5 billion worth of shares, which might sound like a problem, but he's not the CEO anymore. So nobody really cares when he does that, and that's why the stock's only down 1.21%. But he's going to be liquidating about $5 billion. Clearly, he's got some financial troubles going on right there. So shout out to him. I'd Venmo him if I could, because he probably needs all of our help right about now. But nonetheless, what we're also seeing is that their Astro robot, this is a kind of like a home as well as a security site robot thing. It's basically like a little robot that can do just about anything. But Amazon right now has currently designed for utilization in the home, utilization at business locations as a security guard at these business locations. Well, Amazon is going to be forcing Astro into retirement and putting it back to the house, basically forcing it to go home and spend more time with its family. A great idea for a couple of presidential candidates that I can think about personally, but Amazon is doing it to this robot instead. So it is going to be exclusively a home device going forward. That was really all that was going on to trigger the sell-off. Finally, we have Constellation Brands. This is a holding in the WSO Alpha portfolio. Down big time today because they came in with a relatively weak earnings report. It wasn't even necessarily that bad. They did beat on the bottom line, but the big problem was that they missed on sales. That's what sent them down 3.3% because right now, 2023 kind of proved to markets that yes, blue chip companies can cut costs and increase their profit margins, but when you're Constellation Brands, that doesn't really help too much because you missed on sales expectations. And that shows demand concerns going forward. Now, shipment volumes were down about 5.1% in some of their key segments. So, that was the big problem right there. Apparently, they weren't able to raise prices and fuck over consumers enough to compensate for that decline in volumes. Just an absolute rookie mistake. All right, let's go ahead and move on to our final segment of the day. We have Thought Banana. Somebody give me a drum roll, please. That is the title of the headlining section for Thought Banana tomorrow because apes, It's finally here. The most wonderful time of the year, once again, for the third time this year, is finally back on our shores. And we are, of course, once again, talking about earnings season. So next week, earnings are going to kick off on Thursday and Friday. Thursday, we have companies like PepsiCo, ConAgra, one of the biggest food producers in the world. Delta Airlines are going to be reporting on Thursday. On Friday, we get into the JP Morgans, Wells Fargo, Citigroup, BNY Mellon, a lot of the bigger companies. And then in the next week, it's a fucking free-for-all. For the next 3 weeks after that, everybody and their mother is reporting. So analysts, when earnings season is coming up, they start to adjust their price targets and their earnings expectations for companies. So that's what we're seeing right here. This is the S&P 500 change in quarterly bottom-up EPS estimates over the past 3 months. So this is how analysts are kind of changing their thoughts about markets going into earnings season. And what we're seeing is that analysts cut by a lot less than they usually do last quarter. So they cut by about 0.5%, when usually during the quarter, the average cut that analysts give in aggregate is 3.3%. Now it's 3.2% for the last 5 years, 3.4% for the last 20 years, but 3.3% for the last 20. So it's a little bit, well, it's actually much better than that average, especially after last quarter when we were closer to that average at about 2.5%. So analysts are feeling pretty cocky in their assumptions going into earnings season. Now, specifically, the sectors that are giving them the most confidence can be found on this chart right here. It's, of course, consumer discretionary, communication services, and energy. I was a little surprised to see the energy being up there so much because energy prices, if you look at the CPI and the PCE over the past couple of months, have been nowhere but on the decline, and in fact leading the decline. But apparently they're feeling pretty cocky, and it could be things like the travel boom, consistent demand for energy generation from things like air conditioners and shit like that. I don't really know what it is that's giving them that confidence, but I'm sure industrials, materials, and consumer staples wish they had that kind of confidence, because those were the 3 losing sectors. Now, of course, we'll find out next week with all these numbers, kind of like flipping a coin, but that's why we love it. That's where all the fun comes in. So we're very excited to see what these companies come out with next week. I can't fucking believe it. Once again, I don't have a quote of the day in here. Let me just see if I can think of one real quick. Yeah, Jesse Livermore, actually, my literal favorite investor / stock trader of all time. He said, there was nothing new on Wall Street. Basically, he paraphrased a Bible quote, and he said, there's nothing new on Wall Street. Speculation is as old as the hills. What's been done in the past will be done again, that kind of thing. I'm going to drop it in the edition so that you guys can see what I'm talking about on Friday morning. Nonetheless, thank you all for joining me here once again. Happy 4th of July, happy Independence Day, and fuck you, England, to all of the apes out there. Nonetheless, happy investing, happy trading, and bye now.